Welcome to episode 4 of our series on exit planning and having a business that is built to sell. Today's is a lot more technical, so I will be saying, what he said quite a lot, because we're going to talk about how much is your business worth anyway. And it is such a valuable question for you to ask. I'm Cher Cunningham. I'm your coach.
I'm Jim Pillow. I'm your consultant.
We have had some very interesting conversations with people, and it's almost like asking them about Christmas gifts. What is my business worth? How would I figure out whether my business is worth anything? And what can I do to understand what it's worth now and have an impact on that? It's sometimes, often, a delightful place they've never gone to actually look at how is that value calculated.
And it seems like magic, because it is possible that in your lifetime you're only going to sell one business, the one that you've built. Now, some people, serial entrepreneurial folks, end up selling more than one, and you kind of get, once you've done one, you sort of know how that process goes. But often it's just one. And it looks like magic trying to figure out what that business might be worth. But it's actually math, of course, and thousands of businesses are sold every year, and there's some pretty specific things about what that value is going to be. The interesting I find when we talk to clients, because that is one of the questions we ask very early in our process, is, what do you think your business is worth? Or they say, before we even ask, what do you think my business is worth? And we find there are kind of two you'd think that would be kind of a normal distribution thing, that most people would answer something close to what the actual value is, and then, there would be people who would be estimating too low and people would be estimating too high.
He's the finance guy. I would never think that. I would think that people would really typically either very much undervalue or very much overvalue their business. Undervalue because of mindset issues, and struggles in the business, overvaluing it because they need that money or they think they need that money. We had a client who thought he would need to sell for $10 million to be able to retire. He had no idea, so he was putting that value on.
Yeah, so that really is the answers that we had are typically quite low or quite high relative to the actual value. So the expected value is very important. We were recently at a conference and we spoke to a number of the attendees, and that was a very, very common question. Mm-hmm. And a lot of it had to do with people who are, if you've been watching this series, you'll relate to this. If you haven't, do have a look back at them, is because they're within a year or two of exiting and they don't know what they're going to get for their business because their exit planning has come to, it's the end now, and now I need to figure out how to get out of this thing, or how to sell this thing, or how to get value from this thing, and I don't even know what I need in retirement, so I'm going to guess at a number. But it's not magic, it's math.
If I can interject.
Yes, of course.
One of the challenging things that also happens, and what we saw that was a little bit heartbreaking, was people who they don't know and they're afraid to ask, and they are a little bit imposter syndrome-y, and so they're putting it off until what they think is the last minute. And if you are 2 years from selling your business, it's the last minute. It's already here. If you are 10 years from selling your business, and you say this is the last minute, man, you can do some really good things with that business to make it more valuable and more saleable.
And there are two, thanks for that, Cher. There are two technical ways of buying and selling a business. So one of the technical ways is to sell the assets of the business. So you sell your equipment and you sell basically your employees and you sell your customer lists and you sell, so that's selling the assets of the business. The other way to do it is to sell the shares of your business. And selling the shares of your business, if you're a small business, is a really, really, really good tax outcome for you as the seller. It's not as good a tax outcome for the buyer. So there's always this tax tension between the buyer and the seller of a company that you need to be aware of as the seller, because you want to get maximum value, and part of that is getting the best tax outcome. So knowing what the buyer's expectations and positions are and why they are going to have those and what you need on an after-tax basis from it is a very important part of exit planning.
And What's interesting is because you've never sold a business before, typically there's a lot of hearsay out there. And some of it actually comes from people that are advising you. My bookkeeper, my accountant, my lawyer, my friend. Google says nobody wants to buy the shares. And of course, no buyer wants to buy the shares and no seller wants to sell the assets. You need to finish that sentence. It's important to recognize that that's just a negotiation point, and usually around price, not whether to, but what's the negotiation around price if you get to sell your shares instead. And if you put in place everything required to realize that tax advantage, then it's important for you to recognize that just because nobody wants to buy the shares doesn't mean it's off the table.
Maybe we could put an analogy in place that you might think about with your customers. So if you sell the assets of your company versus the shares of the company, if you're properly organized, that's going to cost you 25% of the value of your business. Selling the assets versus the shares is going to cost you 25% of the otherwise value of your assets. And I think that you've been in business, you're very successful, and if a customer came to you and said, I'll buy, but you have to drop your price 25%, you'd go, no, of course I'm not going to do that. So there's this really odd kind of ethos floating around in the professional services world that the person who's selling their business is at the mercy of the buyer. And I do not know where that came from, and it's a terrible thing. But if you build a spectacular business, you deserve to get maximum value for it. And as Cher said, though, it's still a negotiation between a buyer and a seller, but don't go in thinking that you're 25% down off the get-go.
If the reason that if you're contemplating selling just your assets is because your accountant or your lawyer told you that's easier, yes, absolutely, it is easier. It is not better. There is work that you will do, and there's work your accountant and your lawyer will have to do to get you ready to have that impact on the bottom line when you sell. It is absolutely easier. That doesn't mean that's relevant to the decision that you're making on how you want to sell the business.
So selling the business, getting the tax optimized is a very technical, completely well understood. There's no magic here either, but a quite technical thing. So, if you sell the assets, you're going to get cents on the dollar, whatever that number is for your physical assets. Oh, we have a truck, it's worth this much on our books, and we're going to get this much for it. It'll be that kind of conversation about the assets. An exception is real estate. I'm just going to make this as a bit of a side comment. Hopefully you don't have real estate in your operating company that you're selling for the most part. There are some exceptions where that works, but that's a thing that needs to be thought about in early structural discussion about getting the most value out of your company. So you're going to sell the physical assets, whether they buy shares, whether the buyer buys shares or actually pays you for each truck that you have. If they buy shares, it's just like they're buying the whole company and the trucks are in it. So they're going to want to understand what that's worth. The second thing that you're selling really is your know-how. In an earlier episode, we talked about where do I play and how do I win, being the strategic decisions that you make around crafting your business, and the methods with which you develop the arena that you play in and how you play in it that makes you different and makes you valuable and causes you to have better gross margins than your competitors in the industry because you thought very carefully about what you offer and how you price it and how you deliver it. That is an incredibly important piece of the value that you're selling to a buyer. If you've done that, wisely and smartly, you might be more profitable than all of your competitors. People are going to want to buy you.
Even if you are not more profitable, and you're thinking, well, I do things the same way as everybody else. They're a surveyor, I'm a surveyor. They're an engineer, I'm an engineer. We all do things the same way. That's, first of all, not an accurate statement. And secondly, as you onboard people, if you're bringing employees into a business where you have captured and documented the systems that work, that when they work with a customer, they know how to manage and build and protect that relationship, that ability to have your know-how captured in how you run your business. Because again, it's not about you doing the doing of the business, it's you building the business. That's the harder part. Starting and running a business that runs like clockwork is tough. You've built incredible relationships with your clients. How did you do that? How do you maintain that? What are the things that you are doing within the business that ensure that it maintains the successful goals and achievements that you've been doing? When you have that documented and provable, that is hugely valuable. There are a lot of businesses out there that are just kind of marching side by side, hoping everybody figures out what to do and does the doing. When you have a business where you've captured your know-how, you stand apart from those other businesses.
This is going to sound a little bit funny, but one of the best things you can say to a buyer when they're looking at buying your business is that the business doesn't need you. Mm-hmm. That is the best thing to say, which means the know-how and the business plan and the customers and your relationships cannot be in your head. You will undervalue your business. So it's almost like the second step. You decide you're going to intentionally build an exit plan and do some exit thought process. The second thing is get the stuff out of your head. Get your business plan out of your head. Get your customer relationships out of your head. Get your know-how out of your head. Systemize your business, really, is what that boils down to.
Nice thing about that is if you really want to test whether you've done it, go away for 4 weeks. And if you come back and your business has grown, you've done it.
Yeah.
And that level of, you don't want to get to the point where your business does not need you at all, because by that point you probably should have sold it completely already because you've lost the excitement for your business. But you want to get to that point where it does not need you in there every day, that the day-to-day runs without you, and that 4-week vacation is a fun and valuable test.
So your physical assets produce income, and I'll put your employees in that. They're productive units, right? They produce value. Your know-how produces value and efficiency in producing that value and income, and that produces cash flow. And what the buyer of your business is buying, by and large, is your cash flow. Your cash flow next year, your cash flow the year after that, your cash flow the year after that. So having a history of good cash flow, having client lists and relationships documented, the buyer knowing that your cash flow is resilient, so there's not a lot of risk in your cash flow going forward. The more resilient that looks, the longer you've been profitable. The fact that you have a business plan and you've met your plan every year, and you hand the buyer a plan for the next 5 years and they go, you've done it every year so far. Why wouldn't I expect that those numbers wouldn't be true? That is the most robust thing, one of the most robust things that you can show a buyer to prove your cash flow, because that's what they're buying. It seems interesting, right? But what you're actually selling is your future cash stream.
And so we've kind of simplified a lot of how a business valuation comes together, but these are really the key pieces. A business valuator will dive into these with you and dig very deep. It's an exhaustive process to figure out what your true value is when it's time to sell, but these are indicators that are very strong, so you know how you're doing in building the value and the saleability of your business. Because many of these factors, if the business is still tied so tightly to you that you cannot leave, it may be valuable, but it is not saleable.
So we talked about buyers buying your cash flow. There are other reasons why buyers buy businesses. If you think about where you live in we call it a value chain. So the customer's at the top of the value chain, and everybody who sells a service that delivers ultimately what that client wants is part of that value chain. And it's very likely that somebody adjacent to you, up or downstream from you in the value chain, is a potential buyer. It's possible that somebody who is a competitor would buy you. They're in exactly the same part of the value chain, but they want to get bigger. It's possible that an adjacent value chain, so for example, if you're in surveying, maybe an engineering firm wants to buy you or a construction firm wants to buy you. So they're not exactly in your value chain, but they're beside you. So it could be a deep-pocketed buyer. It could be a strategic buyer because you're a really good fit. It could be a motivated or impulsive buyer. So understanding who your business might be of interest to and constructing your exit plan around a potential group of buyers is a really good way to head towards maximum valuation.
Yeah, I think when you know the kind of business you want to sell to, it also informs when you should sell your business. We will often talk about the journey of business success, and at a 1, you're self-employed, you can't sell that business.
Right.
At a 2, you're self-employed with helpers, that's not a business ready to sell. There are different stages at which you're scaling your profit and making a solid, profitable small business, and then you start to grow that business to the point where you're the owner stepping out. There are different types of businesses that you are at each of those stages. And the different buyer will be attracted to a business at a different stage. What is the potential that if they buy your business, they can unlock because of their know-how, because of their possibly deep pockets, because of their existing business? There's going to be a point at which your business is far more attractive before you realize the next level of potential within it. And if you know the kind of business you want to run, where you're comfortable and you're enjoying it, there may be a point where you say, I want to grow it this big, and then sell it to the right buyer.
Exiting businesses is where a lot of interesting business lore comes from. There are some fascinating stories about buyers going in to buy businesses where they already have a seller on the other side that's prepared to pay them a premium, and they're playing both sides. It's a fascinating part of business. I'm also going to say this, although it's tied to exit, but not specifically to your exit. If you're growing your business, it is absolutely an opportunity that you have to acquire other businesses to grow yourself. So you might end up, the things that you would learn in planning for your exit are going to inform the possibility of you becoming a buyer as part of your growth strategy.
Yeah, it's an important point, and again, one of those places where people have never imagined. So if you haven't imagined selling your business, chances are you also haven't imagined acquiring another business. And there's a process to it. I think there's real value in exposing yourself to the idea, brainstorming, doing some planning. It's a great way to take your business from $1 million to $5 million is to buy a $4 million business instead of having to grow to that level. And there are opportunities in the market. Many of our business owners who were baby boomers, there's a huge number of businesses that are going to either close or sell in the next 5 years, looking for succession support, looking for someone interested, and it is a struggle for them.
So value's not magic. Thousands of businesses sell every year, and knowing the mechanics of that, what buyers look for, how businesses are valued, really allow you to tune up where you're going so you're always ready to sell, so that when the opportunity comes along, because sometimes it happens opportunistically, you're at peak value for where you are in your business journey.
Building a saleable business starts the moment you open the business. Even before, if you know what you're building, it's amazing how you can design that path. It'll change, but now you've got a GPS to take you there. But it's not too late, even if you want to sell your business this year. The big thing is to step back. Don't wait till you're in a fire sale. Don't feel like you're in a fire sale. You can take time to step back and go, what would make this better? What would make this more doable, more comfortable, more profitable? And take some time now to put yourself back in the driver's seat on that if you're feeling like you must make a decision sooner than would be wise from a wealth perspective. And would love to have that conversation with you about what are your choices, because we tend to share ideas that people have never seen before, no matter who they're working with as their accountant, their banker, their lawyer. They just haven't explored this path. And we really like to equip you with all the tools that you need to be empowered to turn your business into an asset and realize that asset.
So where can our listeners find out more about this?
We do have that workshop coming up. There's one online on April 18th. Would love to see you in person. There's a longer live in-person version on May 16th. It's called Built to Sell, how to make your business more valuable and more saleable, even if you want to keep it yourself and just enjoy it that much more. We'll put the link to that in the description of this video so that you can access that and get signed up. We hope to see you there.
So I'm Jim Pallow. I'm your consultant.
And I'm Cher Cunningham. I'm your coach. Thanks for joining us in this series.